So you're looking to invest in the stock market, but all those charts and numbers and figures are racking your brain. I know, it makes no sense. In this video, I'm gonna share with you my favorite stock option that can make money every single day, no matter what the market does. Up, down, sideways, it doesn't matter. Stay tuned. What's up, Fruitful investors? Welcome to my channel where, yes, I am a YouTuber, but I'm also a real estate investor, an entrepreneur doing real things in the background, not just up here on YouTube, simply talking about it. So in this video, I'm gonna share with you guys the no-lose stock strategy, which a lot of people know about, but for some reason, so few investors actually do it. But before I get into it, I will say that this strategy really needs a larger account, 300, 500,000 or more in your account to really make that FU money. But if you can get it up there, man, this is like a life-changing strategy. And what I'm seeing is a lot of real estate investors like myself who have made a lot of money in real estate, sold a couple of properties, which doesn't take a lot of properties to make 300 grand, 500 grand, maybe 3, 4, 5 properties, which might sound a lot to you now, but if you watch my videos, I teach you all about real estate and how to buy so many properties. But anyway, if you can sell a few of your real estate properties and bring that money over here, it doesn't really take a lot of properties to start making that huge money with a larger account. So anyway, guys, let's get into it. This strategy is called the wheel option strategy or the wheel strategy. You can find it all on YouTube, tons of videos. Everybody kind of knows about it, like I said, but so few are actually doing it. So let's get right into it. So how this strategy kind of needs to start off, in my opinion, is you need to buy 100 shares minimum of whatever stock you want to buy. So I always recommend buying boring stocks. That's what I'm into. I'm kind of like a Warren Buffett investor. That's what I did with my real estate investing. That's what I'm doing with my stock investing. And that's what I'm doing with my crypto investing. Very, very boring, very, very high level stocks. So for me, I'm investing in the SPY top 10. So the S&P 500 top 10 companies, Apple, Microsoft, Tesla, NVIDIA, what else do we got in there? Berkshire Hathaway, etc. I'm buying all these boring ass stocks that your grandpa probably tells you to buy. Buy Berkshire Hathaway. I've been buying it since 1865. I don't know. So those are the kind of stocks I buy. I don't really buy the Shopify, the AMC, GameStop, even though it's fun to buy all those things. What else, man? I don't know. Spotify, whatever. I don't really buy those kind of stocks. They're cool, they're fun, they're interesting, but I buy the old man stocks because they make me consistent money. So you need to buy 100 shares of them. Why? Because in the option stock strategy, one contract of option strategy equals 100 shares. So whenever you hear the word one contract, that means 100 shares.
Investing in stocks and options can be very confusing. With all the charts, lines, and colors, bulls, bears, what does it all mean? In the Fruitful Stock Options course, Matt teaches you the foundational skills of buying and selling puts and calls, reading charts and technicals, as well as his personal strategy on how to make cash flow every single month, no matter what the market does. Up, down, it doesn't matter. There's a way to cash flow every single day in the markets once you understand how they work. If you're looking for a side hustle to make some extra money with only 10 minutes a day of your time, or whether you want to make this your full-time passion, Matt teaches you the way in this course. Make life-changing money from your phone from anywhere in the world. Enroll now.
So you need at least 100 shares to do this strategy specifically. So let's get right into it and kind of go over a real life example. So let's say Apple, where right now at the time of this video is trading somewhere around 170. So I need to buy 100 shares of Apple. That's $17,000. 170 times 100, $17,000. So you need to have at least $17,000 to buy, Apple, for example, which is a top stock, very, very boring company. So the thing is, 99% of stock investors will just stop right there. They'll just buy Apple at 170 and just kind of go, cool, I'm just gonna wait for Apple to go up, I'm done, and just don't look at it. Well, you could do that, and that's fine, because like you're just banking on appreciation and equity build of that stock. That's cool. But what about making cash flow every single month? We don't just stop right there. So what we actually do is we want to sell puts and calls. So this is where it kind of gets a little confusing, I know. And I have a ton more videos on my channel explaining this in more detail. I have a course coming out actually to explain my whole strategy in very, very great detail. So stay tuned for that. But what we want to do is we have these 100 shares of Apple, right? So we're going to sell a put option, which means, now this is where it gets confused, because selling a put option actually means the right to buy a stock. It's a little bit of a mind mess, but after a while you kind of get the hang of it. So for example, if Apple's at 170, I'm gonna sell a put, let's say at 140. And what that means is, should Apple come down to 140, I have to automatically buy those shares. So I know your brain's racking. Let me give you a real life example of kind of how this happens and why people do this. So Apple's at 170. Let's say Steve in New York has 100 Apple shares, and his wife says, don't lose all of our money investing investing in stocks. Don't lose all of our money. So what's he gonna do? He's gonna look for someone like me, that I'll say, Steve, if Apple goes down to 140, if the market crashes, Apple goes to 140, I'm automatically gonna buy all your shares at 140. Even if the market goes to 138, to 130, to 120, man, there's a real crash going on. It keeps going down. I'm obligated to buy those shares still all the way up here at 140, even if it's sitting at 120 by the time of expiration. So me and Steve make a deal over the phone or over our brokerage app, very, very simple. And he says, yes, Matt, you have to buy my shares at 140 no matter what happens with the market if it goes down. Now, in exchange for that, I'm gonna give you $100. So Steve's gonna give me $100 for that contract for the right to buy his share should the market dip to 140. Now, the beauty thing about this strategy is if Apple doesn't go to 140, if it ends at 141, 142, 143, 145, etc., above the 140, I keep that $100 in my pocket. You see, so I just keep doing this over and over again. And there's a lot more to this, but to be very strategic is to play the possibilities or the odds that Apple's not gonna go down that far, which it almost doesn't do big swings like that, right? So this is called going out of the money. Apple's at 170, I'm going out of the money and doing this contract with Steve at 140. What's the odds of Apple going from 170 to 140 in 30 days? Which is like a date we chose, 60 days, 45 days, that doesn't matter. You guys pick the dates. And it's all done automatically over the app. So you're not actually talking to Steve and like messaging him. Is it okay if we do this deal in 30 days from now? It doesn't really work that way. It's all done automatically over the app, but I'm just giving a person-to-person example for this strategy, right? So Steve feels comfortable. Steve's wife feels comfortable because he's hedging his loss. Should the market dip that far, he's getting out automatically. I'm coming to save the day to buy all of his shares at 140. If the market doesn't drop to 140, well, he lost $100, but at least he didn't lose a lot more, right? So he's happy, I'm happy, and we keep doing that, right? So that's a simple strategy for that. But that's not it. So I'm making money on this way. What about on the way up, right? I own these shares at 170. Now I'm gonna do the exact reverse. I'm gonna sell a call option maybe at 190. So I'm out of the money again. So I bought it on 170. What's the odds of Apple going to 190 very, very quickly in 30 days? Doesn't really happen that often. Apple's a very slow moving, boring stock typically. At the time of filming this video, the market's pretty volatile and it's moving a lot. But typically, or historically, Apple's very slow moving. So I'm gonna do the exact same thing, but the reverse. This time, I'm selling the stock. So I'm selling it to Steve, but the reverse. Okay, Steve, if the market goes to 190, you have to buy all my shares at 190, right? So I'm happy because I bought them at 170. So even if it does go to 190, I made money, right? I bought them at 170, I'm selling them to Steve at 190. I made money, I'm happy. He's happy, he's got a deal for that. And the exact same thing, and he's gonna pay me again for that contract. Matt, if Apple goes to 190, I get to buy all your shares, and in exchange for that contract, I'm gonna give you $100. Cool, so I'm getting money here, I'm getting money here. That's cash flow, right? So how this really works in a more advanced term, so like you can just do that and just set it, right? So you buy 100 shares of a stock, you sell the call option, you sell the put option immediately, you're happy in both scenarios. Should Apple drop to 140? Cool, you're buying Apple at a discount. Awesome, so you're happy. If it does rip and goes all the way to 190, you're selling it at a profit. Cool, you're happy. So it's kind of a no-lose strategy, right? You're happy, right? Either way, what the market does go up, down, doesn't matter. You're winning in a sense because you're getting your way. Now, how to be more strategic and more savvy with this is to time those trades. Now, it's very, very hard because you can't time the stock market because the stock market is its own beast, but we can look at more data, and I could talk about this for 6 hours, and I will in the course on exact detail, but essentially a very easy nutshell strategy of how to time it a little better. Apple's at 170. Let's say the market drops a lot in one day. So you're looking for these vicious pullbacks, 2%, 3%, 4% in one day, or 5% in 1 week, a vicious pullback. So what happens typically when a top stock like Apple drops down 4% in one day or 6% in 1 week? It's most likely gonna go up, right? So that's when it goes down, when it drops, that's when we sell a put option. Because with a put option, if you're playing the cash flow game, you want the stock to go back up. you don't actually want to own the shares at 140. I'd be happy to because it's a cool discount, but I'd rather not. I'd rather it go up after I buy the put option. Why? When the put if we make a deal when the market's down, right? And then the market, we make that put option contract and then I sold it down here, right? If it goes up, well, the odds of Steve having to sell those shares to me are less likely because the market just went up. So he's like, oh man, I should not have sold that contract. The market went up. I'm happy with that because the contract is worth less. Now I know you're probably thinking like, man, this is confusing. Just stay with me. If you watch these videos and you watch the detailed on how to do this like on the computer, which I have other videos doing it, it makes more sense. But essentially, if the market goes up after I did this, the odds of it going back down are less likely. So what that means is the contract is worth less. For example, I'll do another real world example. So remember Steve gave me that $100, right? For that contract. Should Apple go to 140? Now that the market went up, the contract's worth less. So he gave me 100. I can buy that contract back for $30. So here's an example for like a real world example, right? So we sold this, right? So Steve gave me $100. Now the market ripped up. Steve's going, oh my God. Now I'm gonna lose money because I'm gonna lose $100 because like Apple's for sure not going down to 140, right? So I can come around and I can sell that contract back to him. So this is the beauty of stock options. You don't have to wait the whole 30 days. You can get in and out of these contracts whenever you want. So now that the market ripped up, Steve's like, oh man, I shouldn't have sold that. Like the odds of Apple going to 140 are very unlikely. I just lost $100 to that guy in Ontario, Canada. I shouldn't have done that. So I come creeping back in and I go, Steve, I feel your pain. You're probably gonna lose that $100. It's probably gonna happen. How about I give you $30 back? I'll give you some of it back. I'll buy the contract back. We'll end this contract null and void. In exchange for that, I'll give you $30. So Steve's like, oh, I just lost $70, but $30 is better than losing all of it. So I give Steve $30. The contract's over. 30 minus 100 is 70. I keep the $70 in my pocket and I keep doing it again and again and again. So that's the game that I play. I'm getting in and out of these contracts whenever I can, and that's the game I play. When the market dips, I sell a put option because it's most likely the stock's gonna rip up again. That's just what happens. And then I get out of the contract and I give that guy his money back. I ease his pain by giving him some of the money back. Okay, that's like a real world example. It doesn't really work that way, but that's a perfect example of how I can describe it from person to person. And on the flip side, when I sell a call option, when the market rips really high, it goes up 3%, 4% in one day, what do you think is gonna happen tomorrow on these boring top 10 SPY stocks? Well, most likely, it's gonna go back down. It's gonna correct itself. That's what the market does. Ebb and flow, up and down. If it rips up, it's gonna come down probably in a day or two. If it rips up, it'll come down again. So I time the selling the call option. When the market rips 3 to 4%, I sell a call option. When the market goes down, this contract's worth less. Why? The likelihood of it going back up to that is harder. It's harder to go back up. So it's less likely to go back up. Contract's worth less. Same thing. Steve gave me $100. Market dipped down. 3 days later, Steve's like, God damn it. It happened again. No problem, Steve. I'll give you $30 back. I'll keep the 70 again and again and again and again. Anyway, guys, that's a basic rundown. And I'll be doing more detailed videos on the computer of how this strategy works. And in my course, very, very detailed. But that in a nutshell is kind of what I do on a daily basis with the no lose stock option strategy. Market goes up, no problem. I make money. Market goes down, no problem. I make money. I mean, I'd rather the market go up because I make way more money. My stock equity goes up and I make the cash flow. If it goes down, that kind of sucks, but at least I'm making that cash flow on selling put option contracts. Anyway, guys, that's the video. If you learned anything, I hope you did with all the but I love this world. The more you watch these videos, the more you will learn it too. When I first got into stock options, it took me a month. And I'm a pretty savvy investor. I came from real estate, 12 years of real estate. I understand markets, and it took me like a month going, what the hell is a put option? What's a call option? Dude, I don't get it. But after a month of just nerding out and obsessing, it all makes sense and you're off to the races. Anyway, guys, that's the video. I hope you liked it. I'll see you in the next video.